Thanks for clicking. All eyes were on Stats Canada this morning as it was set to release Canada's inflation data for the month of August, with market odds expecting a 90% chance of a rate cut coming tomorrow. We got our answer at 8:30 this morning when headline inflation came in at 1.9%, nearly cementing that rate cut coming from the Bank of Canada. Though, as we'll see in a few minutes, it's not really the headline numbers that's going to make the governor's sock roll up and down, as it is slowing month-over-month core inflation readings. And this data comes as Canada's economy is obviously very much weakening. The Bank of Canada had said that it would be able to cut interest rates if the economy weakened to such an extent that that pulled down price growth, and that does in fact appear to be the case.
This is your chance.
And it's in this context that I want to revisit Canada's money supply, not to explain today's inflation, but tomorrow's, which even the Bank of Canada says is a leading indicator. So what I want to do today is go over Canada's inflation data for the month of August, take a look at what's been going on with Canada's money supply, and then go over some implications. The central bank is going to be making that interest rate decision tomorrow with a press conference held thereafter, and we'll obviously have an update out on both on this channel. Make sure you click like and subscribe if you want to get those updates, but for now, let's get into this inflation data. On to Canada's inflation data. As mentioned, inflation in August came in at 1.9%. Major upward contributors to the inflation rate were meat, gas, tools, rent, and traveler accommodation, whereas travel tours, air transportation, car prices, fresh fruit, and women's clothing put downward pressure on prices. But the real news were the measures of core inflation, the measures the Bank of Canada cares about when deciding whether or not to raise or lower interest rates, with core median staying at 3.1 and core trim dropping from 3.1 to 3.0. And while on their face those numbers don't seem that great, it's the month-over-month increases, or lack thereof, that's going to bring comfort to the central bank, with month-over-month increases stalling for both core trim and core median. Point that had to be explained to Andrew Bell.
But the core CPI trim hitting 3% year over year, and the core CPI median hitting 3.1% year over year. So inflation's still quite a bit above that 2% nominal target.
More will be a bit of a relief for them in the numbers is that pace of the increase in those prices is a bit more consistent with the inflation target. So,
and yeah, as we've talked about before on this channel, it's not so much headline inflation, it's core inflation that the Bank of Canada cares about, and it's not so much the year over year that tells us what happened last year as it is the month over month. And the last few month over month readings have not been overly bad.
Aye.
Bond yields initially popped up on the release, but with yields falling back down, investors still very much expect the Bank of Canada to be cutting at tomorrow's announcement. So Canada's headline inflation data popping up just a bit year over year, but the month over month measurements of core inflation, those measurements the Bank of Canada cares about, slowing down, giving the bank the ammo it needs/wants to cut interest rates tomorrow.
Our lives change forever.
But what is Canada's money supply currently doing? It's an important question. As mentioned, the bank was explicit back in 2011 that money supply growth is a leading indicator of inflation. TD, the Fraser Institute, and the IMF all found something similar in other studies. It's been well documented on this channel and for decades prior. No need to belabor the point, as I think the majority of us understand. So what has Canada's money supply been doing? Well, year over year, growth rates have actually started to drop, falling since April. That's not to say that the money supply is shrinking like we nearly saw in the aftermath of the 2022 rate hikes, but rather to say the pace of increases is slowing. Now, today's inflation isn't explained by the current slowdown in M2. Today's inflation was largely due to gas, meat, tariffs, and probably a little bit left over from this. But today's M2 growth rate, or lack thereof, will be a good indicator for the inflation that we'll see in a year from now, just as the M2 growth rate in February of 2021 explained the inflation rate in February of 2022. I had said about a month ago that if we continue to see M2, Canada's broad money supply, spiking upward, that would be a leading indicator for inflation to come, but it looks right now at least as though that trend is reversing at least somewhat. Now, before moving on to exactly why that is, why the pace of money growth is slowing, I think it's important that we remember that money supply increases stem from money being created, and money is created in Canada when banks extend new loans. new loans like mortgages, consumer loans, and business loans. And there just isn't a whole lot of that going on right now. Canadians are in an awful lot of relative debt, with massively elevated debt to disposable income, right now sitting at 175, compared to about 82 in the United States, meaning the ability of Canadians to take on more debt, which would in fact expand that money supply, go into debt to pay for these higher prices, may in fact be limited. Further, business investment, another major source of borrowing/money creation, is being undermined by economic uncertainty, with real investment dropping 2.3% last quarter, non-residential business investment lagging far behind the United States, and, as we can see, flatlining credit liabilities since February of this year, meaning businesses aren't borrowing, businesses aren't taking out new loans to invest, meaning they're not pushing the money supply increases upward either. And that's not even to mention that there's an awful lot of money about to leave the economy, with the renewal wave just about to kick into high gear, with payment increases in the 15 to 20% range, meaning for every $1,000 in current mortgage payments, about 15 to 20% of that, or $150 to $200, is about to leave the economy. Money that would have been spent into the economy is now going to go to the banks.
We earned it.
Which is actually probably more about money velocity than it is about money supply expansion, but still the effect is relatively the same. That's money not being spent in the economy. That's money not facilitating price increases. And all of this lack of money borrowing, lack of money spending, lack of money creating is obviously showing up in the economy, is showing up in the jobs data. So amidst all this uncertainty, people aren't borrowing, the money supply isn't increasing. That should help to keep a lid on inflation. Not exactly right now, but looking forward 3, 6, 12, 18 months from now. With all of that said, money is also created when the banks loan the government money, when the banks buy up those bonds issued by the government, which it's about to do an awful lot of. But the data that we have right now, the money supply increases that we have right now, just don't point to major massive increases in inflation over the next 6 or 12 months. So when the Bank of Canada Governor Tiff Macklem says he's looking to see which force is more powerful, tariffs pushing up prices or the economy dragging them down, this is exactly what he's talking about. And I think that's what we're seeing showing up in the money supply right now. So today's data, at least the month-over-month data on core measures of inflation, probably giving the Bank of Canada the ammunition it wants and needs to lower interest rates. Further, if the economy continues to weaken to such an extent that it helps to keep a lid on prices, that could very well pave the way for more Bank of Canada rate cuts. On the other hand, as we just mentioned, government spending, government increasing the money supply, which it's about to do an awful lot of, that could provide an offsetting pressure. We will obviously continue to track how all of this plays out on this channel. Make sure you click like and subscribe if you want to get those updates. But for now, thanks so much for watching.